as well. Here's just a snapshot of where we were last summer in terms of the subprime and the alt-A's and all those resetting. And here's a look at what the NODs looked like at the end of the fourth quarter of 2008. So they're definitely starting to pull back from the first wave, and then we've got another one coming. Here's the foreclosure and delinquency rates. You've got a lot of transactions in this market. One of the things that CAR was able to do last year is partner with a company called Foreclosure Radar, and it's there's a variety of companies out there that track foreclosed property. And this company is focused only on California, and I want to show you what they're able to do. One of the things they can do is make a really important key point about local data. This is a look at Stockton. It's from somewhere last year. It's a screenshot from this Foreclosure Radar website. And what it shows you, and remember the 2020 program about Stockton and just so many foreclosures, it's just amazing. So anyway, what's interesting is there's Route 99, and on the west side of 99 there's a lot of stuff going on in the distressed market, and on the right side there isn't. And when you do the satellite view, it becomes very clear that the old established neighborhoods in Stockton were healthy. It's the new product that came online in the boom where people are in trouble, and it really explains it. So even in a place like Stockton, you really can't generalize. Here's just a look at Sacramento. This is kind of the satellite view, and red, you have green, and you have blue, and one of those is auctions, one of those is REO, and one of them is pre-foreclosure, so you can kind of see what's coming on the pike, and then you can also do mapping. And I did a few others. This is Live Oak, Mary's. I'm going to Sutter Yuba after this, so I did some for them too. Here's Olivehurst. Whoops, wrong way, sorry. So anyway, you can, if you want to try this free for a week, the promo code is SWAT09, because we've been doing this also at our SWAT conferences, but go and just don't buy it, but try it out and see if it can kind of help you. I mean, one of the things that it can do is if you have a seller and you're still kind of having a little bit of a reality check with respect to pricing, you might be able to say, look, there's 3 similar properties in pre-foreclosure on this street or in this neighborhood. Why don't we get this done before we have to deal with that kind of competition? So it's kind of a strategic thing. I vaguely mentioned, I kind of just mentioned this earlier, and I want to drive home the point. The rules of the game of real estate finance are being rewritten in Washington this year. So I hope someone at the Sacramento Association, and if I know this group well, I know they have, it's really important to make your contribution for political survival so we can get there and be heard as an organization, because I will tell you, they don't really get our industry. They need our help. One of the issues that's going to come up is refinancing. Do you remember when you couldn't cash out when you refied? I think they're going to be looking at the history of people that got into trouble by using their home as a piggy bank and maybe treating those kind of loans differently than new originations. I'm not making policy here. I'm not even going to suggest my opinion, but I think we all need to be aware that when, as an industry, we were just looking at people buying new homes for the first time or buying a new transaction, a lot of the pain that we're going through right now weren't new originations. They were people that were refinancing and putting themselves in harm's way. Here's just a very brief list of some of the factors that put us where we are today. Everyone should, probably has a different list. Mine starts with personal financial accountability, goes into the exotic loan products and the refi craze, Wall Street innovation, inaccurate pricing of risk. Moody's and Standard & Poor's had brilliant PhD econometricians doing their modeling. The problem wasn't the models, although it actually was. Standard & Poor's, you couldn't put a negative price in their model. It was not ever considered a possibility. But what they did is they utilized, 40 years worth of post-World War II data that was based on mortgages are really hard to get and people will do anything not to foreclose and people always have an equity cushion. Wrong, right? That's not what happened, and that's why things got into trouble. The trade and budget deficits, this really didn't start in housing. This started, remember the big Greenspan drop in the Fed funds rate in 2001 to 2005? That happened at the same time that we were getting into a record trade and record budget deficits. There was a global pool of capital out there demanding high returns. And were they going to get it buying safe Treasury securities? No. But didn't these newfangled mortgage-backed security swap stuff look great? I mean, mortgages aren't risky and the rate of return is higher. So that's part of it. I mean, that's obviously very, very simplistic, but just to give you a feel for what happened. And it came to, I believe, a head the middle of September when you started with, AIG, and that saga's continuing, obviously. You've got the government essentially buying AIG, or 80% of it. By Thursday of that week, you had Paulson and Bernanke on the steps of Capitol Hill saying, quote, if you don't pass this, we may not have an economy on Monday. I mean, at CAR staff, we would go home on Friday with just trepidation. Like, we do not want to turn on CNN on Sunday afternoon because it was just one announcement after another. The fear in the marketplace is reflected in the yield curve. A year ago, or November of 07, it was kind of flat, upward sloping. Last year, at the end of last year, it is so straight, it's so steep because everybody's going short. It's three month or your mattress. Nobody's betting kind of on the long haul. And what's happened is, George Bailey was a portfolio lender. He knew his depositors, he knew his borrowers, he kept the mortgage documents in a safe until they were paid off. My favorite scene in this movie is the run on the bank where George knows he doesn't have enough money to pay everybody off. And so what's he going to do? He's going to explain to people where their money is, and it's a beautiful thing. And then, Frank Partnoy, and I highly recommend this book. It starts in 1990, it came out in 2002, and he really does a good job of explaining derivatives and what was going on in the market and why it wasn't regulated. And he's been on one of the 60 Minutes experts a number of times this fall, kind of explaining what was going on. So our forecast, and I kind of alluded to this, is for about an 8% increase in sales in 2009, and the bulk of that will be happening in Sacramento down through Bakersfield, inside part of San Diego, the places where you've really had, went into the downturn earlier, you've had really sharp declines in prices, people are knowing it's a bottom, and they're out there looking for bargains and buying. The statewide median home price is going to come down to around $280,000 this year. In fact, we're already there because of the high end, because you're finally going to start, and we are again over the last couple of months, starting to see those markets pull back. I'm not sure how I'm doing on time. I'm fine, okay. Just a couple of notes on there's a couple of bills out there. The stimulus essentially reinstated the Fannie Freddie limits to 729 and the higher FHA limit. So all of that is good. It changed the first-time home buyer tax credit. It raised it to $8,000, and you don't have to pay it back. So that's another, huge advantage. The $10,000 first-time home buyer tax credit in the state budget is only for new housing. All right, it's not for existing housing, and we tried very, very hard.